Welcome back, everyone. Today we are going over the tale of two recessions. You may be wondering why some earnings reports from companies make it seem like we are nowhere near a recession, while other companies' earnings reports make it seem like this is going to be a pretty scary, pretty devastating recession. Well, today we're going to look into who's getting impacted the most. Is it the rich? Is it the poor? I'll give you a hint. It's obviously not the rich. So we're going to look at why certain companies are doing well, why certain classes are doing well, while the rich are doing better. And yeah, let's get right into it. So let's get some numbers pulled up here, right? Adults' average real wealth peaked just below 400,000 um, earlier this earlier this year, driving a very solid run up from the pandemic era around 2 years ago. Right. So why is this? Why do we see this large run up? Why are we seeing it start to come down? Well, let's look right into it, right? So for starters, wealth. There's a difference between wealth and income, right? Wealth is a correlation of all your assets, your house, your 401k, cars, all that, right? So if we look at real wealth growth, okay, on this chart that goes all the way back to 2002, we see that the middle class was on a steady pace, a little bit below, but a steadier pace with the top 1%, the 0.01%, right? And then it drops off in 2006. Um, so what happened in 2006? Well, the financial crisis happened, and home prices fell dramatically. And then we see over here, it goes below the chart, right? Then we see over here it starts to rise, um, and rise well beyond, relatively well beyond the top 1%, the top 0.1%. And if we look on a smaller time frame, we see these. Uh, there's a difference now. Um, the top 1%, the top 0.1%, start to decline way earlier than the lower 50%. Um, and why might that be? Why does this chart look the way it is? Well, there's one big reason: housing. The middle class and bottom 50% housing often relates the most to their overall wealth. And so that's why we see this crash in 2006 when housing crashed. And that's why we see this now after housing had a just ridiculous last couple of years. And that's also why we see it hasn't faltered yet, right? The top 1%, top 0.1% have a lot in stocks. So when stocks were falling and housing was still rising, um, the lower 50% saw an increase in their wealth. Um, and this is unfortunate for many reasons, right? Because income is still very different from wealth. Okay, we still see this very large discrepancy in overall income between the top 0.1%, 1%, and it's all relative, of course. But we still see this large gap, especially compared to what we see in wealth, and that's because of housing, right? If your house makes up 90, 80% of your your wealth, you're then you're going to see a large increase in overall wealth when your housing goes up. And it's not the same for these top 0.1%. A lot of theirs is diversified, tied up in other assets in their income. And here we see the growth in assets for the middle class, right? And you guessed it, yes, real estate, owner occupied, unrented real estate had the largest growth out of any other asset class by far, right? Value of value as of mid 2017, pensions, IRAs, 401ks, and real estate were roughly the same. Now we see real estate doubled, almost tripled its value from 2017 to 2020 due to housing, of course. Now, this is not good, as you can imagine, because we have an illiquid asset. This is an illiquid asset that they have no access to. This is not real money, essentially. If you watch The Wolf of Wall Street, fairy dust, right? It is not real money that they can access. They they can't go refinance due to the high mortgage rates. They can't access any of this in cash to deal with the up and coming recession. And so that's why we see these earning reports come out, right? We'll go look at Bank of America's. We see companies whose target audience is less wealthy have poor earning reports. Amazon, for example, Google, they have a large variety of customers, a lot of which ranging in the middle class. And so although their overall wealth, their net value is much higher, much greater than it was previously, it's all tied up in their house, which is illiquid. And so we will see that this kind of catches up to us, especially when housing prices fall. So we will see their growth and their overall net assets start to fall as their housing falls, as the price of their house falls, right? And here we go look at Bank of America's earning report. So consumer and wealth management net revenues saw an increase over the last year and even over the last quarter. All right, I first saw this, I wondered why. And then it hit me. The people who have wealth management are rich, right? They're dealing with this recession in a much different way. So although the poorer people, they're unable to spend money because it's all tied up in their house or whatever. The rich are still out there spending money, getting wealth management, and the rich are getting richer once again, and the poor are getting poorer. And it's at a larger gap than we've ever seen, really, or in a long time, right? Here we go again. Consumer credit worthiness, right? Credit card new accounts. So what are we looking at here? We've seen new accounts grow over the last couple of quarters. Again, a shocking stat until you look at the average FICO score, right? Average FICO score, 770. These are well-credited, richer individuals who are opening these new accounts, right? And then over here, consumer vehicle lending has started going down. And the average FICO score is 780 on them. So these are smarter, wealthier people who are making smarter, wealthier decisions, not buying vehicles when the price is just too high, but opening new credit card accounts, right? So this is where we see that gap. This is where we see the poor people not have the ability to capitalize on as many opportunities as the rich can. And it is showing right now in the earnings reports, in the Bank of America earning reports, in the Amazon earning reports. We just see this large gap that is just only growing from here.